Well, for more on this, I'm now joined by Chris Hart. He's Chief Economist at Investment Solutions, and he's in our Cape Town studios. Thanks very much for joining us, Chris. Now, we've had quite a bit of data out today, but how has the Rand been behaving since the release of these data?
It's not too bad. The Rand is in the 1070s. It was in the 1080s earlier. So basically, it has strengthened a little bit. But of course, there's quite a bit of weakness in the run-up to this, the data. And so basically, I think it's all square at the end of the day. But basically, the market didn't reflect a huge amount of concern about the data.
Now, a narrowing of the current account deficit, that should surely be welcome news.
Hugely, because effectively, when you get a weakening currency, you should expect that current account to narrow. When you get a slowing economy, you should expect a current account deficit to narrow, and so far that hasn't happened. And so to get that narrowing is quite encouraging. But if it's because of lower dividend payments, you may well find that that catches up next quarter. So it really goes in the swings and roundabouts. One wants to see a steadily, how could you say, a trend where it's closing on a reasonably steady basis, and we haven't seen that yet. We haven't got sufficient data points for that, but we hope that we're now on the road to closing that current account deficit.
Presumably, that current account deficit should continue slowing down, given the consumer is under so much strain in South Africa, and presumably the imports are more capital intensive rather than consumption based.
Yeah, very much. If it's capital intensive imports, you'll find that if the infrastructure program and the reason for that continues, you may well find that the current account deficit remains persistently high. But you'll find it's because of investment reasons we have the current account deficit. If it's for consumption reasons, it's not that great, because effectively the current account deficit will then signal that you've got a weaker currency going forward to try and balance it out. And unfortunately, it is a little bit of both. It's not one or the other that's driving it, particularly at the moment. And of course, weak export performance isn't encouraging. But as the platinum industry gets back to full production, you'll find that at least our export performance should improve in the months ahead.
Well, you nicely lead me to my next question. We know that the strike in the platinum sector has caused some problems for our exports. And now we're hearing that it looks as though the deal that we thought would come together is unlikely to happen, given that Amplats is now saying that AMCU is seemingly seeking new demands.
Yeah, well, that's always a problem. And if that is the case, I think one needs to actually look at labour reform. And the one key labour reform that needs to be put on the table is, in fact, that workers need to be protected, in the sense that you have to have a secret strike ballot, so that we know that it's the will of the workers and not just the union, in other words, the agenda of the union leadership or even of management. One needs to actually see what is the actual will of the workers, and these secret strike ballots need to be held on a fairly regular basis. In fact, after each new deal is offered and tabled, so that one is guided by that, because there's just too much intimidation and other sideshows that are happening. And I suspect that the strike would have been over months ago if we just had that simple provision. But the intimidation levels are too high to have open votes. You need a secret strike ballot as a critical reform in labour policy.
All right, Chris, I want to move on to the consumer side of things now. We saw that CPI data came out at 6.6% for the month of May, year on year. Is there room for that to go as high as 7%, do you think?
Very much so. In fact, we're fortunate that it hasn't gone above 7% already. And the reason for that is that the only driver behind the inflation number at this stage is because of the weak rand. The demand pull factors, as we call it, in other words, there isn't really strong demand pull factors. It's mainly cost push factors that's driving the inflation rate, which is why it's reasonably subdued. If the consumer was quite strong, we would have much higher inflation. But because the consumer is in quite a weak state at the moment, we've got an inflation rate at 6.6%. In previous occasions when the rand has weakened to the extent it has, inflation has actually risen quite a bit higher. And so we're in what I call as a classic stagflation trap, that interest rates are at the bottom of a cycle. Usually economies slow down when you're at the top of an interest rate cycle, and we're at the bottom of an interest rate cycle and possibly needing to hike interest rates, and economic growth is slow and inflation is rising. And in fact, your inflation rate is much higher than your growth rate. And so that poses extreme difficulties for the economy, because stagflation is in fact where a country and it's the average person in the economy goes backwards, and we need to try and reverse that as quickly as possible. And the growth drivers are quite weak. And the only real growth driver that we can actually unlock at the moment is in fact investment. And we need to see investment in what I call the wealth producing sectors of the economy, mining, manufacturing, agriculture, so that we can actually start supporting the other sectors of the economy more strongly. And it's the wealth producing sectors that are in fact what has been holding the economy back, particularly manufacturing and mining in the last quarter.
Now, Chris, retail sales put in a pedestrian showing, increasing by 1.8% for April on an annual basis. What does the latest data tell you about the consumer?
Well, it does say that the consumer is in a weak position. If they were in a more robust position, we'd see stronger growth on the retail side, and it's one of the reasons why inflation is relatively subdued. If the consumer is in a stronger position, we would have seen high inflation, and the retail numbers certainly bear that out. It also suggests that when we look at the country's problems, we've got the twin deficit problem of the current account and government budget deficit, but we've also got a deficit at household level. So we can't just transfer the one problem to the household sector. We actually need to resolve this across the board. The spending has gone ahead of our earning, and we really need to turn that around. And it may well be a painful adjustment period as government needs to cut back its expenditure. The Reserve Bank needs to hike rates. We need to actually try and boost the savings rate, and then as a consequence, then transmit that through into the investment rate. And we need to actually try and embed that down at household level, so that it's a small business growth that we actually generate, so that we can generate jobs, because it's small and medium enterprises that is the growth or job creating engine of the economy. That's where we need to do it, and it will be a bit of a painful adjustment period, but we do need to actually make that adjustment. The consumption-led growth that we've been dependent on, that's underpinned by credit, has exhausted itself, and we won't get any more mileage out of that particular growth strategy.
Chris, that's where we're going to have to leave it. Thank you so much for your time. That was Chris Hart. He's Chief Economist at Investment Solutions.